I'm Dennis Tubergen. You are listening to the Retirement Lifestyle Advocates radio program. Have a terrific show lined up for you today. Joining me in segments 2 and 3 of today's program is the head of global research at Elliott Wave International, Mr. Murray Gunn. I'll talk with Murray about his forecast for the worldwide economy, the stock and bond markets, and we'll talk a little bit of social mood with Murray as well. Elliott Wave has pioneered a science known as Socionomics. I know you're going to find it to be fascinating. I'll chat with Murray about that as well. It is July, which means I have a July 2023 special report for you. It is titled Mid-Year Forecast from a panel of experts. To get your copy of the report, as well as some bonus information, including 2 of my best-selling books, one, Revenue Sourcing, the Retirement Planning Strategy for the Post-Pandemic Economy, and the other book, the Little Black Book on Social Security Maximization, will be sent to you along with a July 2023 special report. All you need to do to get this box of information sent to you absolutely free and with no further obligation is visit the website requestyourreport.com. The website again, requestyourreport.com. And when you visit the website, just let us know where to mail the information, and we will be very glad to do so. You know, in the book, Revenue Sourcing, and in the books that I have done prior to that, including New Retirement Rules, including Finding Financial Freedom, I talk a bit about the fact that we are going to have a period of deflation because of debt levels that exist around the world. So just a little bit of history as it relates to this. Ever since 1913, when the Federal Reserve was founded, there have been a pattern of booms and busts. Now, it's really clear, and the easiest way to see this is to go back and take a look at what stocks have done. You can look at the S&P indicator. It was the Standard & Poor's 90 before it became the S&P 500. Just take a look at what stocks have done over this period of time, going back 110 years, and the boom and bust cycle has been very, very clear. Now, the Federal Reserve, for those of you that are not aware, is a private group of bankers. So back in 1913, Congress and President Wilson gave control of monetary policy to this private group of bankers. It didn't take too long, and we had the first boom cycle of the 1920s, followed by a big reset time frame, a big deflationary time frame in the 1930s, and that we call the Great Depression. So the history on this is, after the Fed was founded in 1913, at the time, gold was being used as currency. There was a $20 gold piece that consisted of 1 ounce of gold. And if you went down to the general store or went to the grocery store and you bought $20 worth of stuff, you would throw an ounce of gold on the counter. Well, that whole system was modified just 1 year after the Federal Reserve was founded. In 1914, the Fed began to issue Federal Reserve notes. And these Federal Reserve notes were really claim checks to claim the real money, which was gold. If you go back and look at a Federal Reserve note from 1914, you would see it says payable to the bearer on demand, $20. So the Federal Reserve note itself was not $20. You needed the gold piece to get $20. But if you had the Federal Reserve note, you had a claim check that allowed you to get the real money. Now, the issuance of these notes allowed for the massive and rapid expansion of the money supply. The backing of the dollar by gold was reduced from the U.S. dollar actually being gold, and therefore being backed 100% by gold in 1913, to quickly being backed by gold at a rate of 40%. That allowed the money supply, if you're a mathematician, you know that allowed the money supply to expand by 250%. Now, the result of this money supply expansion, shall we call it the result of this inflation, since inflation is technically defined as an expansion of the money supply, the result of this was a period of time that seemed like prosperity was everywhere. The Roaring '20s, The Roaring Twenties was a period of a debt-fueled prosperity illusion, and I use those words intentionally. A debt-fueled prosperity illusion that ended with a real estate price crash and a stock market crash. The Great Depression arrived with a vengeance. After World War II, the Bretton Woods Agreement returned the United States to a quasi-gold standard. Now, a little bit of history here. In 1933, at about the time that then President Franklin Roosevelt declared a bank holiday, which relieved bankers of any responsibility of paying back their depositors, he also bought back the gold of all American people. If you were an American citizen having gold in your possession, you were ordered by an executive order to sell your gold back to the government. We then had nothing but paper currency from 1933 until the Bretton Woods Agreement, which was 1944. And in 1944, the U.S. went back to a quasi-gold standard. Now gold was actually priced at $35 an ounce, up from $20 an ounce in 1933. Now, in 1971, this gold exchange privilege was revoked by President Richard Nixon. That made the dollar a fiat currency, which it has remained since 1971. So for the last 52 years, the dollar has been backed by nothing. And it's also allowed for unlimited amounts of currency creation. Now, a little bit more to this story. The U.S. really became the dominant, or remained the dominant, world currency because shortly after the U.S. dollar became a fiat currency, the United States executed an agreement with Saudi Arabia, and the Saudis, as part of that agreement, agreed to sell their oil only in U.S. dollars in exchange for military protection and other favors. Now, since 1971, this series of boom and bust cycles has become even more apparent. And after each bust, the response of the Federal Reserve has been extremely predictable. They simply create more currency to reflate the bubble. This currency creation simply adds to total debt levels, which makes the next bust more painful and makes it increasingly improbable, in my opinion, that it'll be possible for the Fed to reflate the bubble. And that is where we now find ourselves. I found an article this past week that reported that worldwide debt is now about $305 trillion. That's more than triple the worldwide debt of 2008 at the time of the financial crisis. And we are seeing now signs that this bubble is in the relatively early stages of unwinding. Now, from December of 2021 to October of 2022, stocks fell about 25%. Since October of 2022, stocks have now retraced about 3/4 of that decline. Now, I believe that stocks remain in a technical downtrend, and I'll get Murray Gunn's take on that in the next couple segments. You'll want to stay tuned for that. But you're also seeing now real estate slow. Real estate inventories are increasing. The median home sales price is declining. There is a perfect storm brewing in commercial real estate. There are very high levels of commercial loans up for refinance in the next 18 months, and there are already almost 1 billion square feet of vacant office space in the United States. So these are signs that we're now seeing the beginning of the deflationary cycle, and of course this is being catalyzed by the Federal Reserve's rate hikes that ostensibly are to get inflation under control. Now, we're also seeing economic data that is not favorable when it comes to the number of corporate bankruptcies, the number of office building owners that are defaulting upon their mortgages. I'll talk about that more in the last segment of today's program. But first, let me again remind you that if you've not yet received or not yet requested the July 2023 special report, you can do so by visiting the website, requestyourreport.com. The website, again, is requestyourreport.com. And when you visit that website and let me know where to mail it, I'll send you the 2023 July special report titled Mid-Year Forecast from a Panel of Experts. I'll also send you a copy of the revenue sourcing book and the little black book on Social Security. That's all free. Just visit requestyourreport.com to get all that information. I'll be back after these words with my special guest, Mr. Murray Gunn. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is the head of global research at Elliott Wave International, Mr. Murray Gunn. Longtime listeners will recognize Murray as a returning guest. You can learn more about Elliott Wave International and Murray's work at elliottwave.com. And when you go to elliottwave.com and check it out, and I would encourage you to do that, there is a resources tab, and under the resources tab, there is the opportunity to get a free book about Elliott Wave. So I would encourage you to do that as well. Murray, welcome back to the program.
Thank you, Dennis. Always a pleasure to have a chat with you.
So, Murray, let's just start, just so we know there's time to do this. When someone goes to elliottwave.com and they click on the resources tab and they request a free book, what can they expect to learn?
Well, they'll be learning about our model that we analyze the markets from. And it's all about the Elliott Wave principle, and that's a fractal, what we call a fractal-based model of the economy discovered by a man called Ralph Elliott in the 1930s. And he discovered that human herding behavior causes markets like the stock market, which is a leading indicator of the economy, to exhibit certain identifiable and repeatable patterns. And the big discovery that he made really was that these patterns repeat at every time scale. And so it enables cycles of herding behavior to be anticipated from the short term to the very long term. So that's why we think that the markets are driven by human beings, and that's why we study human behavior.
Well, certainly human behavior is predictable, so I'd encourage the listeners to go check out that free book at elliottwave.com under the resources tab. And Murray, just to kind of segue into the economy, I just read a piece that worldwide debt now is $305 trillion, up from $100 trillion at the time of the financial crisis, and believe it or not, that's now about 15 years ago. Where does this ultimately lead, in your view, and using the Elliott Wave model?
Well, certainly you've put your finger right on the button of what is going to be probably the biggest issue over the next decade or so, and that is debt. Taking a really sort of big picture view here, just to reiterate what I said the last time I was on your show, Dennis. A few years ago, Elliott Wave International, we were telling our subscribers that 2021 was setting up to be potentially a very significant turning point in history. And we were basing this on time cycle analysis going back to the 1932 stock market low, and there was a confluence of cycles all zoning in on 2021. So it's really absolutely fascinating that spanning that year, we've had a once-in-a-century pandemic, a still ongoing land war in Europe, and one of the most dramatic bond bear markets in history. And that bond bear market is probably what is going to eventually break this debt issue that we've been talking about. And we certainly think this is just the start of a new, very volatile era.
So, to what extent, Murray, do you see bonds declining? I mean, you just used the words in historic bond, a bear market in bonds. Is this going to be unlike anything we've ever seen before?
Well, it already has been. Really, the rise in yields. So when bond yields rise, the bond prices fall. So the rise in yields that we've seen over the last few years, the speed of that has been the fastest in history. And so it really is, we think, just the start of another move higher in yields over the next couple of years. When we last spoke in March, Dennis, I think I mentioned that we expected the global economy to continue to slow down and enter a recession. Well, the Eurozone and Germany are now officially in recession. The UK is close to one, and there are so many indicators in the US pointing to a recession coming there. We've had manufacturing and industrial production are contracting. The housing market has cooled a lot, and of course, the bond yield curve remains very inverted. So that means that long-term, long-dated yields are lower than short-dated yields. And when that's happened in history, that's always pretty much signaled a recession. But it's funny. It's a bit like it's like the Godot recession, like the famous play, waiting for Godot, and he never arrives. Certainly we think that it will, based on the ultimate leading indicator of the economy, which is the stock market, which we think is close to ending its bear market rally that it's been in since last October.
Well, Murray, what's your take on how deep this recession will be? I saw a statistic that I'd like your comment on, along with the answer to that question, and that is that when you look at M2 money supply here in the United States anyway, it's contracted year over year at a rate not seen since 1929, and we all know the depth of what followed then. Are we in for something similar in your view?
Well, we certainly could be, and it might not be as dramatic as the 1930s, but what we're probably in for in this new volatile era is a series of rolling recessions, just a general malaise in the economy. So yes, you're absolutely right. This is the one thing that's a big change. People look at what's happened in consumer prices over the last couple of years and say, the inflation is really bad. And we've all been sucked into this of calling consumer prices and the rise of consumer prices as inflation. But actually, real inflation is a monetary phenomenon. And monetary and credit. And of course, you mentioned at the start there about debt, and debt has been inflating out of control for the last few decades. And since the great financial crisis in 2008, 2009, the money supply has been accelerating as well. And when the pandemic hit, the rise in the money supply, certainly in the US, was completely, literally off the charts. And so, the question we ask is, what did they think was going to happen about inflation, consumer price inflation? And so, they're obviously scrambling now to try and reverse that, and that involves monetary deflation. So what we've got now is monetary deflation, and we think that's going to feed through into credit and debt deflation.
So, just for those listeners who may be joining us, I'm chatting today with Mr. Murray Gunn. He is the head of global research at Elliott Wave International. You can learn more at elliottwave.com. Under the resources tab at elliottwave.com, you can also request a free book. So, Murray, at a certain point, do you believe that central banks around the world will try to reflate the bubble again by resorting to more easy money policies and quantitative easing? And if so, do you think they'll be successful?
Well, I think there's certainly no doubt about it that if the stock markets collapse quickly, and that's open for debate, but if they collapse quickly, then undoubtedly central banks will panic and probably look to ease monetary policy again, but their hands are tied. Obviously, they've tied this rope around their hands to say that they want to try and control consumer price inflation, which ultimately we think is futile because central banks really can't control anything. Everything's driven by human herding behaviour. And actually, the central banks follow what the markets are doing, as we've shown our subscribers over the decades. But yes, we think that the central banks will probably continue to keep monetary policy relatively tight unless something dramatic happens in the stock markets.
So let's talk a little bit about stocks in the time we have left in this segment. Then we'll pick it up in the next segment. In past interviews, you have offered quite a bearish forecast worldwide when it comes to stocks. Have you changed that view at all?
No, not at all. In fact, it's playing out pretty much as the Elliott wave principle would suggest it does. I mean, stocks topped out. A lot of stock markets topped out in 2021, and so the rally that we've seen in many stock markets since last October is what we call a corrective rally. So the initial decline was the start of a bigger bear market, and what we've seen since last October is a corrective rally. And we can tell that by looking at the sort of technical analysis of the markets. It's not been confirmed by increasing volume, and if it's a healthy advancing bull market, you want volume to be going up as well. That's not been happening. As been well documented, there's been very narrow breadth in the market, and that means that the rally has been concentrated only in just a few stocks, certainly in the case of the US market. And that is very consistent with corrective waves under the Elliott wave principle. And we've got bullish sentiment at the moment is very elevated. The statistics have just come out for the Association of Individual Investors, showing that bullish sentiment there is the highest it's been since the top, I think 27 months ago. And so people think that the bull market is back, and that's another aspect of corrective waves. In the first part of an ongoing bear market, people think that the bull market is back because they don't want to think about a bear market. And the point of realization comes in the third wave down. And so once this corrective wave is over and the third wave down starts, that's when we could see quite a dramatic turn down in the stock markets.
Well, my guest today is Mr. Murray Gunn. He is the head of global research at Elliott Wave International. The website is elliottwave.com. On the resources tab there, you can get a free book that Murray's offering to the listeners today. Again, the website is elliottwave.com. I'll continue my conversation with Murray Gunn when RLA Radio returns. Stay with us. I'm Dennis Tubergen. You are listening to RLA Radio. My guest on today's program is the head of global research at Elliott Wave International, Mr. Murray Gunn. You can learn more about Elliott Wave's work at elliottwave.com. There is a resources tab at elliottwave.com. If you click on the resources tab, you'll see there's an opportunity to get a free book explaining the Elliott Wave principles. I'd encourage you to check that out. And Murray, let's just jump in where we left off in the last segment. You had mentioned that it's your view that the current rally we have seen in stocks since October of 2022 is a bear market rally or a counter-trend rally, and you cited the fact that there has not been a lot of volume supporting this rise in prices. You mentioned that there hasn't been wide market participation from a lot of stocks. And you mentioned the sentiment is now extremely bullish, and then you explained that we're ready really for a third wave down. And I think there may be some listeners that aren't familiar with the wave principle that is really instrumental in interpreting market behavior under the Elliott wave principle. Could you maybe explain in a little bit more detail what you mean?
Well, sure. I mean, what Ralph Elliott discovered back in the 1930s was that the basic pattern of growth in the world, in the universe, in the stock market occurs in a series of waves, and these waves occur, if we're thinking about the stock market in particular, in a 5-wave up, 3-wave down pattern. Within those waves, we have smaller waves which have the same sort of patterns in them. So when, as we think now, we've had, if we look back spanning centuries, we've had essentially, we're at the top of a 5-wave up movement. So what we're looking at now is quite a large bear market occurring. Now, that will probably occur in what we call an ABC correction. That's a 3-wave movement. But within those waves, there will be a whole series of 5 and 3 patterns. And so within this first movement down that we're seeing now, since the top in 2021 for a lot of indices, that occurred down in October last year, and we think that is just wave 1 of a 5-wave movement down, which will eventually make up this much larger wave A movement. So what we've seen since October is what we're calling a wave 2 movement, and when that is complete, the third wave down will occur, and third waves are generally the most powerful wave in the pattern, and like I alluded to earlier on, that's because certainly in terms of corrective waves in bear markets, as we've seen now, which we're coming to the end of, people think the bull market is back. They will be disappointed when it's not, and markets start to turn down, and at some point, that's when what we call the point of recognition occurs, and that's generally in the kind of middle of a third wave down. And that's when you tend to get very powerful moves.
So, Murray, a couple of questions regarding what you just said. First of all, this wave 2 corrective wave. You can correct me if I'm wrong, but by my calculations, looking at the major U.S. stock market indices anyway, we've retraced maybe around 75% or so of the downtrend from December of 2021 to October of 2022. When you look at some of the technical indicators, like the Fibonacci retracement levels, don't we have to be close to this wave 2 counter trend rally up ending?
Yes, absolutely. We are. You're absolutely right there, Dennis. The thing about second waves, that they can be very deep retracements, and that's again what I was alluding to just there. Was they tend to be deep because people. The first wave down comes as a shock to people, because at the top of a bull market, everything's rosy, everything's fine, all the news is good, and the first wave down comes as a bit of a shock, and so the second wave, corrective wave in this bear market that we're looking at now, they tend to be quite deep corrective waves because people think that nothing's changed, and people think that the bull market's still back on. And so that's the reason why second waves in particular can be quite deep. So yeah, the 75%, 77, 78%-ish, that's kind of a nice turning point in terms of, what you were talking about, Fibonacci levels. But yeah, we think it's the turning point is quite soon. And one of the clues for that, just we were looking at today, was looking at the what we call the junk bond yield spread, without wanting to get too technical for your listeners. But there's a big relationship between the performance of corporate bonds and the stock market, for obvious reasons. If the stock market's going up, then earnings are good and debt can be serviced, etc. But it does look from particularly the junk bond yield spread, that's reaching a point now where it's going to turn probably over the next couple of months. So we think that into the end of this year, we'll start to see some deterioration in the stock market.
So, Murray, given that wave 1 down was, I'm going from memory here, so correct me if I'm wrong, approximately a 25% decline and we've seen a retracement at this point of about three-quarters of that. How low do you think stocks could go at the bottom of wave three?
Well, certainly we would be looking at possibly a 50% decline from where we are right now. It really it varies, and we have to see how the waves develop. It could be quick, it could be slow. Generally, it's probably going to be relatively quick, given that it's probably going to be a third wave. So yeah, 50% down is not it's not an unviable kind of target to have.
Murray, at the outset of the first segment today, you talked about the fact that the Elliott wave principle is really rooted in the fact that human behavior tends to be predictable. And Elliott wave also has pioneered a study that I believe you've dubbed Socionomics. Could you talk a little bit about what Socionomics is, and then we'll get into maybe what it's telling you about what might lie ahead?
Yep. Well, Robert Prechter's socionomic theory stems from evidence that it's the trend in social mood that determines social actions, not the other way around, as most people tend to think. We're conditioned to think that way. Most people think that if something negative happens, then the mood of society then turns negative. But what Robert Prechter's proven and others have proven over the decades is that socionomic studies suggest that the negative mood trend comes first before the negative action. And of course, vice versa for positive actions. So, for example, conventional thought would be that recessions cause business people to be cautious. And the socionomic theory just turns that on its head and says that it's actually cautious business people who cause recessions. So, because social mood is the driver of everything, it tends to show up first in the stock market. And so the trends in stock markets can anticipate social actions. And also social actions can help us anticipate where we are in the stock market cycle in that way.
So, Murray, when you look at the science of socionomics and you apply it to where we are right now at this point in time, in July of 2023, what are some of the more significant trends that you're observing?
Well, if we're right and there is a huge supercycle turn happening, which has been happening over the last few decades, to be fair. I mean, given the fact that Japan topped out in the 1980s, Europe topped out 20 odd years ago, China topped out in 2007, and so it's really just America that's been the sort of last man standing, if you like. If we are right, and so generally, mood is turning into this negative mood trend era. Then some of the things we're seeing right now are reminiscent of that. We've got globalization is in retreat for sure. I mean, if you look at the Inflation Reduction Act in the US, it's protectionist, and I think that is annoying and concerning a lot of countries. So the EU is starting to do the same. And just this week, we saw the UK doing the same with attracting manufacturing by the use of subsidies. So globalization is dying off, and that is part of the negative mood trend. We've also got, in terms of politics, we've got, if you look at Europe, for instance, it's certainly shifting more to the right. And what happens in negative mood trends is that the politics goes to the pole, if you like, goes to the opposites, the extremes. And so there's more support for Europe, from Europe for the war in Ukraine. Europe's turning more anti-immigration. And we've got the Spanish elections this weekend, which will likely show another shift to the right. We've also got labour market strikes going on all over the developed world at the moment, despite the labour market actually being quite strong, which is quite an interesting juxtaposition there. But perhaps the most worrying thing from a sort of geopolitical point of view is a pattern. I think we mentioned this the last time, we see in the China stock market. As I said, China stock topped out in 2007 in its stock market, and it's been in a bear market since then. And specifically, what we call is a triangle pattern, a kind of sideways movement in the stock market. And what usually happens at the end of these bear markets, which is driven by a negative social mood, you get a negative social action. So it's not surprising, therefore, that Taiwan is becoming much more talked about within geopolitics. So it wouldn't surprise us in the least if something happened with China and Taiwan over the next few years, based on socioeconomics and based on the Elliott Wave principle. But on a lighter note, if there can be a lighter note for this, developing negative social mood, one of the things that's been interesting to us is this idea of this summer, in the Northern Hemisphere at least, is we look at pop culture and popular culture, because it can be a big indicator of what's happening in socionomics. So you've got, in the movies at the moment, you've got this phenomenon that's happened called Barbenheimer. So where the Barbie movies come out, which is obviously, Barbie, light and fluffy, and Oppenheimer, which is completely the opposite, obviously, about the atomic bomb. So you've got this kind of chase going on between the two, and that's kind of very reminiscent of what's happening from a socionomic point of view in terms of the changing mood that's going on, because you've got these two competing elements. But actually, if you sort of dig a little bit deeper into it, it is interesting that the Barbie movie itself is actually kind of anti-Barbie. So it's a little bit negative in that regard as well. So all of these things point to a developing negative mood trend, which is consistent with the fact that the stock market's topped out 2 years ago.
Well, my guest today has been Mr. Murray Gunn. He is the head of global research at Elliott Wave International. I'd urge you to visit Elliott Wave International's website at elliottwave.com. And if you visit the website and click on the resources tab, there is a free book offer for the listeners. So, Murray, always a pleasure to have you on the program. Love to have you back down the road and get an update from you. Thank you for joining us today.
Well, thank you, Dennis. It's been a pleasure.
We will return after these words. This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubergen. Glad you're listening in today. Thanks again to Mr. Murray Gunn of Elliott Wave International for joining me on today's program as well. Quick reminder, I do have available for you the July 2023 special report titled Mid-Year Forecast from a Panel of Experts. Go to requestyourreport.com. Let me know where to mail the report, and I'll be very glad to get it out to you, along with the revenue sourcing book that contains a retirement planning strategy for the post-pandemic economy. I'll also send you a copy of the Little Black Book on Social Security maximization. In the first segment of today's program, I talked about the fact that ever since the dollar has been a fiat currency, really ever since the Fed was founded in 1913, it's really easy to see that there's been this series of boom and bust cycles. And after each bust, which typically adversely affects stocks and real estate, you see the Fed now creating more currency to reflate the bubble. Now, it remains to be seen if they will do that as this bubble unwinds, and I believe that we are now in a bubble. As I mentioned, worldwide debt now stands at $305 trillion. That's more than triple the worldwide debt that existed in 2008 at the time of the Great Financial Crisis. And as I talked about with Murray Gunn in the last two segments, stocks have retraced about 75% of their decline that began in December of 2021. And I agree with Murray. I think that this is a wave two counter trend rally. I believe that sentiment levels are quite high, and I believe there is more downside ahead. So that is my opinion, and I believe there is a lot of fundamental and technical data to back that up. Now, that suggests that if you are continuing to plan for retirement using traditional strategies, traditional investment strategies are likely going to let people down in the near future, in my view. Stocks remain in a technical downtrend. Real estate inventories are increasing. And the Epoch Times reported that corporate bankruptcies have now reached their highest level since 2010. I'll give you just a bit from an article that was recently published there. Quote, new data show that a growing number of U.S. firms are collapsing under the weight of higher interest rates as corporate bankruptcies reach their highest first half level since 2010. In the first 6 months of 2023, there were 340 corporate bankruptcies. In the first 6 months of 2023, there were 340 corporate bankruptcies. That tops every comparable span in the last 13 years. That is up 93% from the same period a year ago, and even higher than in 2020 when there was a big spike because of the economic shutdowns related to the coronavirus pandemic. Now, on top of this, Dorothy Newfield recently wrote a piece for Visual Capitalist that talks about the fact that there is a lot of office space available in the United States. This is bad news for commercial real estate owners when the commercial real estate houses office space. I'll give you a bit from Dorothy's article here. Quote, in April, one of America's largest office owners, Brookfield, defaulted on a $161 million loan. The loan covered 12 office buildings. These office buildings were mainly concentrated in the Washington, D.C. market. The company Brookfield defaulted because of low occupancy rates and the fact that interest rates are also rising. Dorothy put a graphic together that showed nearly 1 billion square feet of empty office space in the United States. The number is actually 963 million square feet of office space that is now vacant. And if each of those floors was 20,000 square feet with 11-foot ceilings, there would be 48,000 vacant floors of office space. That would reach into the thermosphere where the International Space Station orbits the Earth. Wolf Richter reports that the commercial mortgage-backed securities delinquency rate tripled in the last 6 months. The delinquency rate went from 1.6% to 4.5%. That's according to TREP, which tracks and analyzes commercial mortgage-backed securities. So we have what I believe is a deflationary storm brewing, and I believe that you'll want to equip yourself with some good information. That's why I'm offering the July 2023 special report titled Mid-Year Forecast from a Panel of Experts. When you go to requestyourreport.com and request the report, just letting me know where to mail it, you'll get the report as well as the revenue sourcing book, as well as the little black book on Social Security maximization. So again, the website, requestyourreport.com, to get all that information, requestyourreport.com. That's all the time I have for this week, but I'll be back again next week with a brand new program. Have a good week.